Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Rio Tinto stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Rio Tinto is the world's second largest mining company in terms of market cap, behind BHP. It produces iron ore, aluminum, copper, diamonds, gold, and much more. It is the second largest producer of iron ore in the world. 2/3 of its revenue comes from iron ore. 98% of iron ore is used to make steel. Steel is used in many things such as roads, buildings, bridges, auto parts, etc. China imports 75% of the world's iron ore. And China's real estate uses 25% of the world's iron ore. If there is a recession in China, that could negatively impact this company's stock price. 20% of Rio's revenue comes from aluminum. Aluminum can be found in bike frames, ladders, mailboxes, staples, nails, computer parts, golf clubs, window frames, aircraft parts, and so much more. The company is headquartered in the UK and was founded in 1873. The ticker trades on the New York Stock Exchange, London Stock Exchange, Australian Stock Exchange, and Xetra in Germany. Let's get started with the model. This is a large cap company, 126 billion market cap. They're trading at $78 a share, and they have 1.6 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow was huge in 2021, nearly 18 billion. Free cash flow is the cash that's remaining to pay you, the investor. That's why they pay such an amazing dividend. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's really high at 23 billion. Revenue is the sales for the company, and that also peaked in 2021 at 63 billion. This is the company's income statement. The top line is the revenue of the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to mine all their products is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit. Then below that is their operating expenses. These are all the expenses not directly tied to generating the revenue. Examples are payroll for support functions, also depreciation and amortization. Then below that is their operating income, which is almost as much as the prior 2 years combined. They paid $661 million of interest on their debt. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is their net income, which is more than double 2021 and more than triple 2019's number. This is the company's income statement directly from their financial reporting. And this shows us 2020 and 2021. Their revenue in 2021 was 64 billion. Since China uses so much iron ore because they're building so many homes for all the people they have, that's why they have the most sales in China, 57% in 2021, 13% in the US, 9.5% from Asia, excluding China and Japan. Japan 8%. Europe, excluding UK, is 5%. Canada is 2.5%. Australia 2%. UK about 1/2 of 1%. And all other countries is 3%. Iron ore is a bulk of their revenue at 42 billion. 12 billion from aluminum and aluminum products. 3.3 billion from copper. Titanium 2.1 billion, gold 1 billion, diamonds 500 million, and all other products 1.8 billion. Their operating profit went from 17 billion to 30 billion. Their pre-tax income went from 17 billion to 31 billion. So their net income more than doubled from 2020 to 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And they generated more cash flow than ever in 2021, over 25 billion. They do spend a lot on CapEx. When they buy the rights to a location, that's part of CapEx. Also, the machines they use for digging and excavation, that's part of CapEx. Operating cash flow minus CapEx gives you your free cash flow. And their free cash flow in 2021 was on another planet, close to 18 billion. They usually buy back lots of stock, over 5 billion in 2018, 1.5 billion, 200 million. They did not buy back any stock in 2021. In the past 4 years, they've been decreasing their debt load. They paid down $2 billion of debt in 2018, only added $54 million. And each year after that, they paid down a little more debt than they issued. This is their statement of cash flows directly from their financials. So we should get more information than Yahoo Finance. The first part of the statement of cash flows is cash flow from operations. That went from $16 billion to $25 billion. In their investing section, they spent over $7 billion of PP&E. Last year it was $6 billion. The other items in investing were pretty minimal. In their financing section, they paid out $15 billion of dividends. Last year was $6 billion. They added $1.5 billion of debt. They paid down $1.7 billion of debt. They paid $358 million towards a lease payment. So in their financing section, they had a cash outflow of $16 billion. Last year was a cash outflow of $7 billion. I like tracking a company's revenue and cash flow from operations. This is their revenue since 2015 and their CFO since 2015, both peaking in 2021. The forecast is for these numbers to decrease over the next few years. The reason their revenue and cash flow is so high is because the price of the underlying commodities came up so much in 2021. Commodity prices can't go up forever, so they should retract. But even if they retract 10, 20, 30%, the company is still making a ton of profit. This is the equity section on their 12/31 balance sheet. They have $51 billion of equity. If you add up these first three numbers, that's how much they raised from issuing common stock. So about $8 billion. And they profited $33 billion from running their business. Retained earnings is a sum of all your prior net incomes minus the sum of the dividends you paid out. Let's look at the capital structure. $51 billion of equity, $14 billion of debt. They're 79% equity, 21% debt. And they could pay off all the debt with the cash on their balance sheet and still have $1.5 billion of cash left over. This blue line is their equity balance since 2015. The red line is their debt balance, and the green line is their cash balance. The company has a really good capital structure. Their equity is a lot higher than their debt. Their debt has been going down over the years, and now their cash balance is higher than their debt. I gave them the highest whack on Finbox, 7.8%. I think this makes my model a little more conservative, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $153 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $151 billion. We divide that by 1.6 billion shares. And we get a calculated stock price of $93. They're trading at $78, so they're trading at a 16% discount. It's a buy according to the model. The last time I did a video was in September. The stock was trading at 66. My valuation was 88. The stock has come up about $12 since then. It's up to about 78, and my valuation is a little higher. Their revenue is projected to decrease 10%, so I decreased their revenue 10% for the next 4 years. That's how I got their future revenue estimates. And they convert 23% of their revenue into free cash flow. The way you figure that out is you sum up these 4 free cash flow numbers and divide by the sum of these 4 revenue numbers. And that comes out to 23%. So I multiplied their future revenue estimates by 23%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $91. They're saying it's 14% undervalued. 3 analysts priced this stock, and all 3 have it at $70 a share. This is where the stock has been trading the last 5 years. The light blue line is the stock, and the thick purple line is the S&P 500. In the past 5 years, this stock has gone up 87%, while the S&P went up 81%. This bottom chart is the price of iron ore for the past 5 years. Rio stock price is highly correlated to the price of iron ore. It seems very similar, right? It's not identical because Rio works with other commodities, but the bulk is iron ore. The company pays a regular dividend and a special dividend. In March of 2021, the regular dividend was $3.76. In August, it was $4.17. That gives them a yield of 10.17% and a payout ratio of 57%. And it's 72% of their free cash flow. They paid a special dividend of $1.85 in March and 62 cents in August. If you add the special dividend to the regular dividend, their yield is 13.3%. Most companies don't pay a special dividend, but if a company brings in a lot more cash flow than expected, sometimes they will pay a special dividend. The blue line is their dividend yield since 2011, and the green line is the dividends they paid since 2011. They're currently at their peak in dividend payments, and that is expected to come down, because obviously you can't pay double-digit dividends forever. They have a beta of 0.57, so the stock is not volatile. It's gone down 13% in the past 52 weeks, while the S&P is up 12%. The 52-week low is 60, the high is 96. And the stock is trading above its 50-day and 200-day moving average. Over 4 million shares are traded each day on this stock. Of the 1.6 billion shares outstanding, 1.4 billion are on float, 10% are held by institutions, and 1% of the shares are shorted. Their employee count was higher in 2016 at 55,000. They're currently at 49,000. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $25,000 today. That's a 9% annual return. But you would have been in the red for a while until about 2-3 years ago. Then the stock shot up, plus the nice dividend payment. They pay their next dividend on 4/21. The ex-dividend date is 3/10. So if you buy the stock on 3/10 or after, you will not get the 4/21 dividend payment. 57% of the shares are held by institutions, 31% by the general public, and 12% by private companies. Their biggest shareholder is Aluminum Corporation of China. They own 11.3%. Then Capital Research, Vanguard, BlackRock, and Norges Bank. Since 2021 was their best year ever, they have really good price multiples, a PE of 5.6, that's stock price over earnings per share. That means an investor pays $5.60 for $1 of earnings. Below 15 is considered a really good PE ratio. Price to sales of 2.0 and price to book of 2.5. Let's look at their non-current assets. $900 million of goodwill. Goodwill is the premium you pay when you acquire another company. $2.8 billion of intangible assets. Examples of this are patents and trademarks. $65 billion of property, plant, and equipment. $3.5 billion of investments. $196 million of inventory. $3.4 billion of deferred tax assets. This will help the company reduce its taxes in the future. $2.1 billion of receivables. This is how much money other companies owe this company. Since the number's in non-current assets, that means this money's owed in more than 12 months. And $500 million of other. Let's look at their non-current liabilities. $13 billion of debt. $660 million of taxes payable. This is how much money they owe the government in taxes. $3.5 billion of deferred tax liabilities. This will increase the amount of taxes they pay in the future. And $16 billion of provisions for its employees for their retirement. They have a really high ROIC of 48%. They can cover their interest payments on their debt 46 times. An amazing ROE of 44%. They have a good current ratio of 1.9. That's current assets over current liabilities, and a quick ratio of 1.5. Let's look at their current assets. $5.5 billion of inventory, $3.6 billion of receivables. This is how much money other companies owe Rio. $2.5 billion of other, and $13 billion of cash. In the US, current assets are listed most liquid to least liquid. But for British companies, they're listed least liquid to most liquid. Let's look at their current liabilities. $1.4 billion of debt, $8 billion of payables. This is how much money Rio owes other companies. $1.4 billion of taxes payable. This is how much money they owe in taxes to the government. And $2.1 billion of provisions for their retired employees. So everything in current liabilities is owed within 12 months. Everything in non-current liabilities is owed beyond 12 months. They generated $18 billion of free cash flow in 2021. They have $12 billion of working capital, and they paid out $13 billion of dividend payments. So they're really well funded. They have almost $17 billion of funding. The best way to look at ratios to compare them to companies in the same industry. There are 37 companies in the same industry as Rio. Rio ranks second in market cap behind BHP. BHP is massive. Rio is better than average in every single category. They spend the most in CapEx. They have a better debt to equity ratio. They pay a really high dividend. Their free cash flow is enormous. And their price multiples are much better than average. By looking at these ratios, the stock seems like a steal, right? They generate more revenue than any company, even more than BHP, and they have a lot smaller market cap. Their revenue is not growing as much as BHP, but it is better than average. And they have a really high ROA, that's net income over assets. That's how well the company uses its assets to generate a profit. And ROE is really high at 44%. That's how well a company uses its equity to generate a profit. So to summarize, I have them trading at a 16% discount. But the stock price is dependent on the price of iron ore. If the price of iron ore stays steady, then you're going to make a ton of money because you'll get a big dividend payment. If iron ore goes down 10 or 20%, you'll still be fine. If iron ore increases in price, you're going to be making money hand over fist. But if iron ore drops 40% or more, that could be a problem. But no one can predict the price of anything, especially a commodity. I think it's a great stock for a long-term hold. I'm bullish on most of the commodities they offer. I'm really jacked to see how this company performs in 2022. I rank their free cash flows, revenue, and ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.